We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Rafi Farber, the author of The Endgame Investor. How are you today, Rafi?
I'm doing well. How are you?
Excellent. Thanks for joining me. So why don't we start by having you tell us a little bit about your background and how you've come to be an author in this space?
Well, I came to the libertarian movement and first discovered my interest in money around 2012 with the Ron Paul movement. So Ron Paul really activated my interest in this, and I started reading Austrian economics and Mises and Rothbard. So that really got me into it. But my thinking in terms of this area really started when I was much younger, and only memories that came to the fore really only when Ron Paul kind of activated my mind in this. So I tell the story a lot, but one of my earliest memories as a kid and trying to figure out money was asking my father why prices always went up, because that didn't make any sense to me. In my rudimentary logic as a child, maybe 7 or 8 years old, I was thinking, well, if prices always go up, everything is eventually $1 million. I don't know how long it's going to take, but like, how are you going to have so many zeros on every bill? Like, how's that going to work? Mm-hmm. So, and then my father said, well, that's how the economy grows. Inflation is how an economy grows. And I remember thinking, it doesn't sound good, but okay, whatever. And then I remember taking economics classes in high school, and supply and demand I understood, and this and that. And then when it got to the macro, I'm like, GDP and this and that, like how much money is being. I remember thinking like, well, how much money is being exchanged? Doesn't that just have to do with how much money you make, how much money you print? Like, how does this add any information? I remember thinking like, this is stupid. Maybe I just don't get it, but I just lost all interest in economics because it didn't sound real. It sounded like voodoo to me. And then Ron Paul and the whole Austrian school got me into the whole human part of it, the human exchange of goods and services and subjective value, and that made sense. Mm-hmm. So that's how I got into it, and how I became an author. Very simple. I lost my job around COVID when it started. I was a freelance writer doing projects, but I didn't really like it, and I've always had this interest. So when I lost my job, I just decided, okay, now's the time. It looks like this is the end game, so let's do it. Mm-hmm. The end game investor. So that's how it started.
Interesting. So on your overview on the Endgame Investor on Seeking Alpha, one of your points is describing your service is that the U.S. debt treadmill is on the verge of explosion. So what has happened since June of last year with U.S. Treasuries?
Oh, you mean the interest rates going up? Well, in the first 2 months of the COVID era, right? You had the government raising trillions of dollars, mostly in short-term debt, which means that T-bills. There's three kinds of treasuries. There's T-bills, which are about 1 month to 1 year maturity. Then there's treasury notes, which are 2 years to 10 years, and then there's bonds, which are I think 20 years is also included in bonds, and up to 30 years. Mm-hmm. So at the beginning of this, they raised a whole bunch of money through short-term bills. And then what happened was after April, May, June, you started seeing a treadmill, meaning that they would raise about $1.6 trillion a month and then pay it back with the next tranche of $1.6 trillion in bills that they would raise. So that's the treadmill. Now, most of that money they didn't use, so it sort of went back into the system, and Yellen is putting it back into the system now. Taking that money from the Fed's account, the Treasury's account at the Federal Reserve, and just pushing it into the banking system. So you saw that was into June. So around March, she started taking that money and pushing it back to the banking system. And what happened is that all this money that Biden is going to have to spend from all of his infrastructure spending and the $1.9 trillion direct bailouts to consumers and all this, he's going to have to raise that money through notes, the 2-year and 10-year maturities, because they're not raising any more money with T-bills. So you're going to have all of this spending being raised through 2-year to 10-year maturities. And the market is seeing that all this spending is not going to be raised through short term because that's all saturated. And the amount of issuance that is going to be necessary over the next year or two, or however long this whole Ponzi scheme continues to last, I don't know. It's going to have to be absolutely enormous. Mm-hmm. And the Fed is going to have to monetize basically all of it. Because if you look at the TIC figures, the Treasury International Capital figures, right, the foreigners are not adding net to treasuries. They're not doing it. They're not dumping yet. But if you look at the international capital figures for treasuries from 2008 until around 2019, 2020, they really heavily financed the debt that was issued in the 2008 bailouts, and then all the spending that happened through that period. Not happening anymore. So the Fed's going to have to monetize basically all of it. And, so the smart banks or whoever holds this stuff is starting to get out of it, while the going's good. While real interest rates are still negative, you can still get out of it. So, so rates are starting to rise in the 2-year, 10-year maturities. We haven't even seen the gargantuan issuance that's going to be necessary for all this spending. It's going to come out in the next few months, and interest rates are just going to keep going up and up and up. And the Fed has two choices: either it can suppress rates, or it can let them rise. And if history is any guide, recent history is any guide, they're going to suppress them, and that is going to require a lot of new money printing, more than anything we've ever seen so far.
I absolutely want to get to the yield curve control, but that kind of fits into your view of, let's say, silver and gold. But does this mean that you're looking, your outlook for the dollar is leading to a very hyperinflationary environment in the next, let's say, 2 to 5 years, or what's your timeline, Rafi?
Whenever I get the timeline question, I hesitate because, look. If we're going to bleed this into social commentary for just a second, the amount of money printing that is happening now seems to be proportional to the amount of insanity that is happening in the world in terms of the utter totalitarian control of everybody, and the vaccine passports, and it's just the amount of. It's all in the same engine. It's all the same corruption engine. So the more money that's printed, the more crazy people tend to get, and they expect, thousands of dollars to come into their bank accounts where they can sit and watch Netflix all day, and it makes them very suggestible. It's sort of like a form of hypnosis, it seems. So if you look at the money supply, it's going vertical. It's going vertical now, and I don't think it's a coincidence that the Federal Reserve has stopped publishing money supply statistics every week. They've now published them every month, and they kind of jumble the figures as to what is what. And I've been following these for years, and many people that I know have been following it since the 1970s. And now this is, they've blacked it out. It's on a 6-week lag or something, and they want to make it less frequent. So there's still something, but the monetary inflation that is happening now is already vertical. It's already hyperinflationary in terms of the money supply. So the question of when will this affect consumer prices is really, the question is, when will this affect the commodity space? And it's already happening. It's already happening. In April, right? April, May 2020. We had the lockdown, so we had a drastic reduction in the amount of commodity demand. So you saw oil go to negative $35 a barrel and all this weird stuff going on. But prices were pretty stable in the supermarket, right? But now commodity prices are starting to rise. And even though the reason that prices were pretty stable in the supermarket is because demand was falling, even though the money was being printed. It's the same thing that happened in the 1920s, right? Prices were stable in the 1920s. That does not mean there was no inflation. There was plenty of inflation. It just got revealed when FDR repriced $1 to $35 per ounce instead of 21 or whatever it was. That was like an instant inflation. So yeah, when does the hyperinflation in terms of the Weimar stuff happen? I don't know exactly, but there is no escaping it. That is what is going to happen. And my suspicion is that it will become hyperinflationary in the classic Weimar sense of, prices going crazy in dollar terms when it becomes absolutely obvious that food prices are out of control. Because the Fed can lie about inflation, of course it does, but it can only do it so much. Because once people realize that their food bills are out of control, you can't hide it anymore. And then people start dumping money just to get rid of it. And they start hoarding food and hoarding this and hoarding that. So we're getting there. It could really be any time. I mean, there's so much stuff, so much, they say in Hebrew, like Homer Nefetz, explosive material in the banking system, places that we don't know. You could have an explosion somewhere that nobody expected. In 2008, it was like Iceland. You just had the explosion of what's that hedge fund or that family office that blew up, Archegos. I don't even know how to pronounce it. But you have all this stuff going on, and there's going to be an explosion somewhere, and it could happen overnight. I mean, I don't know, but that's the inevitability here because the printing will not stop.
So that kind of brings us to gold and silver, Rafi. A lot of our listeners understand that, on a let's say longer timeline, gold and silver are great hedges for inflation. So why don't we start by talking about your definition of price manipulation and how that leads into gold and silver?
Well, my definition of price manipulation. Well, I think you're referring to one of my articles on silver, right? Mm-hmm. So, I mean, we like to complain about price manipulation a lot, but we need a hard definition for what it is. So, price manipulation, really, if you're going to go back to Austrian school economics, is, for example, the minimum wage, charging a certain amount for labor illegal, and you have to charge a certain amount for labor, let's say $15 an hour. And if you charge less than that, you go to jail. So that's real manipulation. But anyone can charge any amount they want for gold and silver. You could say you can try to sell your ounce of gold for $5,000 an ounce and see if anybody buys it. I mean, nobody will, because you can probably get it for less than that. But so the question is, why can you get it for less than that? So the answer is simple, because most of the stuff is paper. You can't, so someone with a lot of gold or silver is going to be able to supply it to you for much less. Because most of the people who buy it as a monetary reserve, they are not interested in the physical material because they see it not as money, they see it as an inflation hedge. Mm-hmm. Gold and silver are not an inflation hedge. They are money itself. That is what money is. And the only reason that the dollar has any value in the present is because it can still buy some amount of gold and silver. That's one thing that a lot of libertarians get wrong, that they see gold and silver as just another way to accumulate dollars, whereas it's not. It's not, because one of the objections to that people who imagine gold bugs as people who just like this shiny metal because they have this weird thing about them and they like swimming in it like Scrooge McDuck or some kind of cartoon they have in their heads. Why do they like gold and silver? It's just a metal, but it's useless. I mean, yeah, gold is historically fairly useless in terms of industry, except people like using it as jewelry, or that's usually what it was for. So they think Okay, so this metal is just for jewelry, and then now it's money. That doesn't make any sense. So they say, no, gold and silver isn't money. Why? Because if you go into a supermarket and you try to buy something with gold and silver, they're not going to accept it. I understand that. I get that. That's true. But then I say, here's the retort to that. Now, go into a supermarket with a wad of dollars or Canadian dollars or shekels or wherever you happen to live, and all these fiat currencies are based on the dollar itself. Try to go into a supermarket and buy any amount of food with all that paper or credit on your credit card or even Bitcoin, which is indexed to the dollar, and try to buy food with money that cannot buy any amount of physical gold and silver because there's just none available. Mm-hmm. Then, it's not going to work. It's not going to work because once the money cannot buy any amount of physical gold and silver, the money is dead, cannot buy anything. So there really is no such thing as a fiat currency in terms of a currency that simply has value because the government says so. That brings to mind another memory of mine in my economics class, my macroeconomics class in high school. They were discussing the gold standard. The dollar used to be backed by gold, but now it isn't. So what gives it value? It's simply that the government says it does. That's a lie. The dollar doesn't have value because the government says it does. The dollar is not a fiat currency. There's no such thing as a fiat currency because a currency always has to link back to some past index of something for people to know basically how much everything is worth and the relative scarcity of goods on this planet. Mm-hmm. There is no other. You can't just introduce a currency out of nothing and say, here's a flarg, 100 flargs for a table, 7,000 flargs for a house. I mean, and have it not relate to any existing monetary system. It can't work. So it always has to go back to gold. Bitcoin has to go back to the dollar, which has to go back to gold. It all regresses back to that. So now, why would someone manipulate the price of gold and silver? And the only way it being possible is to pile a bunch of paper gold and silver on top of a physical supply of it, because that's how you would manipulate the price. You would increase the claims to it, which is the same thing as inflating the dollar supply over the gold supply. It's just a different kind of inflation. It's inflating the paper gold supply over the actual gold supply. So in order to maintain the dollar's purchasing power in any capacity, it has to buy some amount of gold. And you can suppress that by increasing the futures contracts that exist for gold. So the manipulation, not in terms of you're not allowed to charge this amount for gold, but you could call it the tinkering, you could use any other word that you want. The manipulation is not necessarily in the 7 o'clock in the morning attacks that you see on the COMEX every now and then, or bullion banks dumping 20,000 contracts in a minute. That's annoying. But the real manipulation of this whole thing is the very fact that gold and silver have a futures market. That's the manipulation itself. Because when we were on the gold standard, quote unquote gold standard, it wasn't even a gold standard back then because it was still being inflated. But before there were a gold and silver futures market, before that even existed, the price of every other commodity on the commodity exchange was priced in gold and silver. Gold and silver was the money. So that was the price. And now that the money is dollars, or the gold substitute is dollars, the very fact that they can even issue these contracts for more gold than they have, that is the fraud. That is the manipulation. And when that falls, the true supply of gold is revealed, and then the dollar would be devalued to that and be worth maybe 30,000, 40,000, 50,000. It depends how much money they print by then and by the time it falls. Mm-hmm. Nobody knows. But what's going to happen is that holders of dollars are going to be a lot poorer because they're going to have a lot less purchasing power. I mean, imagine being alive in 1934, right? When FDR said, okay, now the dollar, now gold is, it was 21, now it's $35 an ounce. So if you had gold and you sold it to Roosevelt for $35 an ounce, so you got those dollars, so you didn't feel the damage, right? You have the same amount of purchasing power. But if you didn't, you just had dollars. Let's say you just had dollars, you didn't have any physical gold in 1934 when he took it all. So on let's say on Monday, your purchasing power was so many ounces of gold, And now it's like, what was it, like 34% less or whatever the number is from 21 to 35. I'm not going to do the math right now, but it becomes a lot less. So that's exactly what's going to happen this time. When the true supply of physical gold gets revealed, which is when there's a run on it and people, they feel this panic and they go for the monetary reserves for gold as money, then the true supply of gold that really exists and who really has it is going to be revealed, and everyone else with dollars and all their fiat currency, they're going to be devalued to that supply, right? And then purchasing power among people is going to radically shift. It's going to be very quick.
So, Rafi, why is there why is there suddenly such a huge premium for physical silver right now? Well,
there's a huge premium for physical silver right now in terms of monetary silver. Mm-hmm. The answer is that the futures market in gold and silver basically treats gold and silver as an industrial commodity. It's priced for gold and silver as industrial commodities. So if a jewelry maker wants gold to make rings or necklaces or whatever, or Elon Musk wants silver for the batteries in his Teslas, or solar panels or whatever he needs them for, it's basically priced correctly. But when there's a monetary panic and everyone goes back to the regression theorem to what money really is, it's hardwired into our evolutionary psychology, even, or social psychology, let's say 5,000 years already. When they all go into it at the same time, the futures markets are not prepared for that. And there's a shortage of monetary silver because all of a sudden people are starting to wake up to the fact that maybe they should really protect themselves with something with historical significance that is money and that is logically must be money now, because this does not look right. People see it. People see what's going on. Most people have not woken up yet, but we saw in early February, and you can go back to an interview. I don't know if you've done interviews with Andy Schefman and the CEO of Miles Franklin. These people are reporting monetary silver sales through the roof that are not stopping. And the premiums on the premium on the physical is revealing what the true paper exchange rate, I don't even call it a price, I would call it a paper exchange rate for the physical silver is. And the way these premiums are going to go down is somebody's going to raid the COMEX, take the silver, sell it to the mints, get the money, the differential between the paper price and the physical price, and arbitrage that and take the profit. It's happening. I mean, we're seeing silver leave the COMEX now. I think we saw something like 3.4 billion ounces go off the registry at the COMEX on April 1st, and another, I think, 2.4 billion leave the building. This is happening.
Mm-hmm. So why is a run on silver similar to a bank run, Rafi?
Well, in a bank run, the problem is that the bank made too many promises, right? So they have all these pretend dollars on their books that don't really exist. And people try to get their money out. And they can't because the money isn't there. So when people go to silver, which is the real money, the base of all the value of the dollar in the first place, mm-hmm. And silver. Let's just clarify what silver is. I mean, so gold, the dollar is exchangeable for gold. That was the window that closed in 1971. The dollar is still exchangeable for gold. We run a dollar gold standard, but silver is really retail gold. So it changes its exchange rate relative to gold. Sure, it's not as stable, but it's still a kind of gold in that it is retail gold. So when there's a run on silver and as a monetary reserve, the higher the value of silver goes, the more people want it, right? For commodities, you have a negative feedback loop system where the higher the price for something goes, the less the demand for it. Because why does the demand for a commodity or a good go down when the price goes up? Because you want to save money, mm-hmm. because the money is what you want to save. But if you're going after, if it's a run on silver, it's a run on money itself. So the higher the value of the money goes, the more you can buy with it. So it feeds itself in a positive feedback loop. And that's what a bank run is. That's what a run on silver is. It's a run on the entire global banking system. It's not a run on a specific bank. It's a run on money itself. So that is the foundation stone of the entire system.
So in that article, you're saying that banks have a vested interest in doing this manipulation because if the dollar falls too fast, the value of the bonds on their balance sheet plummet, causing a systemic banking crisis. So is this another one of their motivations for really controlling the silver price?
Yeah, I wouldn't even say, I don't know for sure if they're even doing this consciously, thinking it's not like they believe that silver is money, therefore they know that they have to control the price in order to keep the bonds. It's not that. It's more of that they've amassed this huge short position in gold and silver as an effect of all this bond buying. I mean, it all kind of fits itself together. So they're not even aware of the fact that if the price of silver in dollars goes up, then that is a reflection of the prices of everything really going up. I mean, we saw it in 1980 with silver reaching $50. Why did it reach $50? Well, I mean, even the CPI, the manipulated CPI, was at 15% at that point. Mm-hmm. So you saw silver going parabolic, going vertical. That it was also happening in 2011 when inflation was when the dollar index was at a low, and this is what was happening. So it's not so much that they even realize they have a vested interest, more that the amount of paper in the system and the amount of money flowing into the paper market, into debt, is diverting value away from real money. And it's kind of like it's a puzzle that they don't even really understand that they're in. It's hard to even explain.
Mm-hmm. So maybe we can take one piece of that, Rafi, and why don't you explain to us what backwardation is and what it's telling us about the market right now?
So in backwardation, you would expect a commodity to become more expensive into the future. Meaning oil delivered into the future is more expensive than oil delivered now, because you have all the insurance costs and the storage costs to store that oil into the future. Now, when oil is in shortage, then you have these industrial interests that need oil delivered now, so they're willing to pay a higher price for it. Mm-hmm. Because oil is consumed, there can be a shortage. Same with grain, same with wheat, same with any consumable commodity. But gold and silver, really gold really. I mean, you could say that silver is a consumable commodity, but not as a monetary store of value. Gold is really never consumed in anything, so you can't really have a physical shortage of it. But there was brief gold backwardation in 2015, but that's a different story. So when gold is in backwardation, that signals a gold shortage, but there can really be no such thing as a gold shortage. So what's really happening is that people are paying a premium to get rid of dollars faster. And that really is the same thing as what hyperinflation is, right? When you're trying to get rid of dollars. A good definition of hyperinflation really is not so much that the prices of whatever basket of commodities you're measuring goes up a certain amount. That's all arbitrary. You could pick any number for it. It doesn't matter. The real point where hyperinflation exists, when you can say, okay, now we are in hyperinflation, is when the desire or the demand to hold money, to hold dollars, to hold whatever paper money, inflated money supply, to hold that as a monetary reserve falls to zero, right? Because what you're doing in a hyperinflationary environment is you're trying to get rid of money as fast as possible for anything that'll hold its value. Mm-hmm. Sometimes you can get gold and that's great. Sometimes you can't. Sometimes you'll buy whatever it is, whatever's there. Just buy it. Just get rid of the dollars. That's what gold backwardation is, because gold can't be in a shortage. It means that that holders of dollars are looking for a different monetary reserve to compete with it. Mm-hmm. So if we ever see gold in backwardation, we've seen it briefly, but if you see it on a sustained basis, you know that the end game is very, very close at hand. Mm-hmm. So we saw it in silver in 2011, I think, or 2010. Remember the exact numbers. We saw it in silver in March. We saw it very briefly in February when silver spiked to $30. But since the COMEX has so much silver, they can flood the market when they need to. See, the thing is, eventually they're going to run out. Eventually. Mm-hmm. And when they do, silver and gold are going to go into backwardation, and they're not going to be able to suppress the price anymore. Mm-hmm. It's not going to work at some point. So I would monitor the supplies in COMEX. I don't know if they can get any more. It was very strange what happened in March. Because all of a sudden you saw this huge influx of physical gold and silver into the coffers in New York, more than any in history. And and ever since it started to go down, just in the past few months, it started to fall. When you see the physical premiums in the monetary markets. So as that falls, and I don't think they can get any more, not at these prices. Mm-hmm. So when the physical supply of gold and silver starts to fall very fast in the COMEX, and you see not just delivery numbers, but you see actual metal moving out fast, then you want to sound the yellow alert. And it's falling now, not so fast, but it is falling significantly for the first time since the inflow stopped. Mm-hmm.
So, Rafi, what conditions do we need to see for gold and silver to really start to rebound from these levels? And does it have to do a lot with the Fed instituting some type of yield curve control?
Yeah, it's not so much that gold has to rebound, right? If we're going to see gold and silver as money, then really the question is, when do we see the dollar start to lose, people start to lose confidence in the dollar again and go for a different monetary reserve, which is gold and silver. I mean, it's not euros, it's not yen. The euros and yen are basically dollars because they're backed by dollars. It's just a competing dollar. Mm-hmm. So the question is, when does confidence in the dollar start to fall again? I think again when commodity prices really start to rise fast. When we're already starting to see some of this overheating, right? When the lockdowns are finally over for good, in terms of people can travel again, people can do this and that again. I mean, they don't even have to end completely because eventually people are going to need to buy things, you know. This brings me back to a point I was making earlier in the interview. That back in April when food prices were rising, right? Food prices were rising in April and May, even though commodities were going down the toilet because demand was plummeting, but not because the money printing hadn't had an effect yet. It just started. So the reason that food prices were rising back then was that all the demand that would have gone into travel, that would have gone into all these industries, that would have gone into entertainment or whatever people weren't allowed to do anymore. Like they had to go somewhere. People had to, all the demand was into food because you have to go to the supermarket. You have to buy food. You have to eat the same amount. Demand for food cannot go down as long as the population is stable. It can only at best stay stable. So all the prices, all the demand for stuff was going into food because that was the only thing that people were allowed to buy and use. Now, the prices of commodities are going up and the demand for food is the same or slightly higher because the population is slightly higher than it was back then. And so you're going to have prices rising for two reasons, because they still can't travel as much as they could before, because they're poorer than they were before, and also because the prices of commodities are going up. So when the prices of commodities become very obviously rising, that cannot be denied anymore, I think that's the end. Mm-hmm. There's no stopping it this time because, Paul Volcker, the Fed chairman during the 1980 inflation spike, he was able to save the dollar by raising interest rates to around 20%, raising overnight interest rates. That's what saved the dollar. That's why it is still a functional monetary reserve now, a functional money substitute for gold now, because interest rates incentivize you to keep that money and not spend it because you get interest on it. But raising interest rates now is absolutely impossible. Absolutely impossible. So when food prices start to rise 5, 6, 7, 8% by government admitted measures, that's it. There's nothing else that can be done. It's over.
So what is the SLR and what does it have to do with this situation?
The SLR, I forgot even what it stands for, the supplementary leverage ratio or something. The SLR is what is the ratio of real assets, the ratio of capital to assets on their balance sheet. I call it real stuff versus paper stuff. So paper stuff has to be backed by real stuff on the balance sheet in order to give the bank some semblance of stability. So back in April, May, June, I forgot exactly what month it was, the Treasury was issuing so much paper that had to be bought by these banks because they are the primary dealers. How debt auctions work is that first the government sells it to a primary dealer bank or a foreign central bank. Kind of both of them participate in the auction at the same time. And then the primary dealer bank sells it into the market on the secondary market, and then you get 10-year yield or 20-year yield, whatever yield it is. So because they were issuing so much paper, the Fed had to give an exemption for commercial banks and allow them to not count all this treasury paper that they had to finance on the primary market, to not count it as a paper asset. If it's not counted as a paper asset, then it doesn't have to be backed by real capital. So that allowed them to, load up on this stuff really, really quickly. But now that SLR exemption that excludes treasury paper from that calculation is now repealed. So all that paper that the banks now have on its balance sheet, it now has to be backed by capital in the same ratios as before. Because in a quantitative easing transaction, when the Fed prints money, right, it exchanges, it gives a bank dollar reserves and it takes the treasuries, so that those dollar reserves are still on the balance sheet of the bank. They're still paper assets and they still have to be backed by capital. Mm-hmm. So all this paper that they now have, whether it's in excess reserves or whatever it is, has to be backed by capital. And the banks have basically two choices. They can either raise capital by issuing shares or whatever, however it is they want to raise it, or they can get rid of the paper. So I think they're going to get rid of the paper. And for some reason, we haven't seen the whole thing collapse yet. But at some point, it's got to. They've got to get rid of a lot of the paper. And at some point, we're going to see a very stressed 2-year to 10-year auction somewhere. We've seen very poor 7-year auctions in terms of very, very low bid to cover ratios. A bid to cover ratio is how much money is bid to buy these treasuries divided by how much is actually being offered. So we saw a very, very low bid to cover ratio in the 7-year, I think back in February. So we're starting to see the stresses, but one of these days we're going to see a very stressed 10-year or 30-year auction or something. And there's going to be some kind of a panic because these market making commercial banks that fund these primary auctions, when the treasuries go straight to market, they're not going to be able to buy. They're going to have to turn them down. I mean, we already heard that J.P. Morgan is already turning down some deposits. So one day they're not going to be able to fund these auctions, and it's all going to be up to foreign central banks. So you have this circle of central banks that are buying each other's debt and keeping the prices down, but it's all a circle. It's all a game of musical chairs, and it's got to end. Mm-hmm.
So do you think this exemption will get reinstituted, and what might happen to the gold price when it does?
I don't know if the exemption will be reinstituted. I think in order for the exemption to be reinstituted, there'd have to be some kind of panic. But if that happens, I mean, I don't know what would be worse for the Fed if this SLR exemption cancellation leads to some kind of failed treasury auction, or if they just go in and then institute yield curve control in order to control the prices of bonds that way. But in order to, if there is no extension or reinstitution of the SLR exemption, then eventually the Fed is going to have to step in and buy the bonds directly, and that would be extremely embarrassing. So, I mean, I don't really know how this continues for much longer. What the numbers are, all you can see is that the money supply just keeps going up faster and faster and faster, and everybody in the world seems to be getting crazier and crazier with how they're behaving, and demand is about to be unleashed as seems to be some slight ease in this global lockdown situation in many countries. Maybe not in Canada, maybe not in Israel, definitely, but yeah, I mean, I don't see how this can last much longer. I just don't see it.
Mm-hmm. So, Rafi, do you think that the banks are using this opportunity or using this, let's say, price level in gold as an opportunity to cover their short positions?
Yes, you can see that. I mean, you can see on the COT reports, the commitment of traders reports, the short position of the bullion banks has gone down to, I think, 120,000 contracts. It was up to, I think they covered like something like 60,000 or some really huge amount they covered over the past 2 months, and it's been really dropping. But that's a good sign. That means the amount of paper gold relative to the amount of actual gold is falling. But whatever they do, eventually this is going to be revealed when the physical supply has to go out to the people that want the monetary stuff. I mean, we're seeing shenanigans or some kind of weird stuff going on with the Perth Mint, where they're shipping people Chinese gold bars apparently, or they're changing the amount of days that they say that it takes gold to be delivered. Unallocated gold accounts. Unallocated is basically the same as paper gold. It's the same thing. It's like an ETF because it's a promise to pay you gold. These unallocated accounts that call for delivery, they're not getting it. I'm not following this situation as acutely as others. I mean, there's one, John Adams, that seems to be following it very well. It's not just the COT reports that you see that on the commitment of traders, but any institution with an unallocated account that holds unallocated promises for gold is basically short gold because they are selling you a promise for gold. It means promise to give you gold, but if they don't have it and they promise to give it to you, that is the definition of selling short. That's what it is. Mm-hmm. When you don't have something, you sell it, then you have to buy it back at a lower price. So when institutions like the Perth Mint are saying that unallocated accounts are going to take longer and longer to deliver, they are short gold and they cannot deliver it. Mm. That's what it is. That's what's happening. So if the silver, the silver raiders, the Redditors, whatever it is, they just keep going on this line, eventually they'll win. I mean, it's going to take time. It's not going to be easy, but they're onto the right thing. It's not Bitcoin. Banks couldn't care less about Bitcoin. Bitcoin's a nice speculative asset. It's not money, in my opinion. It can't possibly logically be money because when Bitcoin came into existence, it had to be indexed to some existing monetary reserve, which was the dollar. So you have gold, dollar, Bitcoin, right? It's a chain: gold, dollar, Bitcoin. Dollar depends on gold. Bitcoin depends on the dollar. You cut out the middleman, Bitcoin falls. I mean, it could be worth $1 trillion of Bitcoin, but if the dollar is worth anything, what does it matter? Doesn't matter.
Yeah, that's a great point, Rafi. So in that vein, could we see gold and silver get remonetized?
It will either be remonetized by force from the government when they run out of money, right? When hyperinflation hits, And this is another important point, that Murray Rothbard, the famous Austrian school economist, he was a Brooklyner, when he wrote about hyperinflation in Man, Economy, and State, in his magnum opus on economics, he didn't describe it as some kind of tragedy. And it certainly does have tragic consequences, because it means that everyone who didn't have real money and only had paper money and realized that it's no longer exchangeable for any real money and therefore can't buy anything, they really get poor. And that is the tragedy. But the process of hyperinflation itself is not a tragedy. It's a defense mechanism against continual theft of purchasing power. When the people say, no more, you cannot do this anymore, we're dumping it. We're getting rid of it, so you can't print anymore and you can't extract any more value from us. That's it. They could get remonetized in the event that the world attacks the dollar, that the public, and the attack on the dollar is not going to come from banks, it's going to come from the public in the supermarkets and the street. So they could try to save themselves by saying, okay, now gold is exchangeable for the dollar at $30,000 an ounce, $40,000 an ounce, whatever it is. They could do that if they have the gold reserves to monetize it, to do that. And if they do that, then there will be a test. I mean, people will come with their dollars to wherever the government says you can get your gold, and it will be tested. And if it doesn't, if they say, oh, you can't get it today, you'll get it in a week, they'll keep dumping. It's not, it's not going to work. But whether the government does it or not, I'm kind of hoping that they can't. I'm kind of hoping that they already got rid of all their gold reserves. I don't know what's in Fort Knox. I don't know what's really in the Bank of England. I don't know. I'm hoping none of it is there. People will say, oh, it's not there. That'll be a tragedy. But yeah, it'll be a tragedy for everyone who holds dollars and pounds and all this other paper. But in the bigger picture, if they are the bad guy, and they are, because they are shutting down life and they're giving us green passports and they're destroying our liberty in ways that I didn't even imagine, 10 years ago. Mm-hmm. If they're doing that, I hope it's not there, because that means they have no resources and all the gold is somewhere else. Where is it? It's probably in the hands of rich people. Good. Let rich people have it. At least they were smart enough to buy it, which means, they have some kind of mind, some kind of brain, and they'll hire people and they'll pay them with gold and silver. They'll make corporations or whatever. They'll buy the existing capital of existing corporations. Hopefully Amazon has no gold in its stores. Jeff Bezos can be bankrupt for all I care. And the rich people, the rich libertarians that are really stacking gold and silver now and just buying and buying and buying. Those are the people I want in charge of the world. Those are the people I want to raid Fort Knox. Hopefully they have it, and hopefully the governments don't have it. And the real liberty-minded people that really care about human values and human freedom and human happiness, I hope they have it. The middle class, like me, can buy as much as we can. So I'll do that. Hopefully we all will. Hopefully only libertarians are the ones buying gold and silver now. That's what I hope. Because that means we'll remonetize gold.
Excellent, Rafi. Is there anything you'd like to add as we wrap up here? Yeah.
I hope to see you at the Endgame Investor. You can Google it. Just Google Endgame Investor. It'll be the first link. Mm-hmm. And I focus really on the COMEX and what's going on in the gold and silver situation. I do a little bit of trading. My philosophy is to maintain emotional balance, which means you picture the worst possible scenario that could be. And if your trades go against you, and if you feel okay, then you have they have a good allocation. If it makes you nervous, then you're going to want more cash in the meantime to just keep your mind steady. And as a lot of us are losing our minds in this environment for good reason. If you can keep it together through this assault, through this relentless assault on human life that's going on, then you've really got a strong mind. And this really is only the strong survive in terms of mental toughness. This is what it is. So really, the people that get through this, through these lockdowns, through this assault, they're the strong ones. And when you buy gold and silver, when you buy real money, you're really saving the division of labor and putting real capital into the hands of responsible people. This isn't just about making money. This is about saving the future of the human division of labor and saving the planet for your children from a financial sense. I mean, there are freedom fighters on the street that are fighting these green passports and everything else. We are on the financial side of this. We have a responsibility, a moral responsibility to buy real money now, to control the real supply of real money so we can maintain the division of labor and save as many people as we can, because there's going to be a lot of destitute people when this is over.
Excellent, Rafi. We'll absolutely link to your Seeking Alpha blog in the show notes. Rafi, thanks so much for your time today.
You're welcome. It was a real pleasure to talk to you, and I'm a big fan of your channel. You're doing great work.
Thank you very much. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.